what you think young people most need to know about the Federal Reserve and how it operates.
Well, the first thing they should know is what it is. The Federal Reserve is, of course, a very important economic institution, and I think every informed citizen should know at least the basics of what the Fed is and how it's structured and what it does. A good economics class is going to take students a little further. It's going to explain what is monetary policy and how does it work. I think a very basic thing that often gets lost is the difference between monetary policy and fiscal policy. Monetary policy is the responsibility of the Fed. Fiscal policy is responsibility of the Congress and the administration. Those are very different. They work in different ways, and there are different sets of responsibilities there. So understanding the distinction between those things, I think, is very important. The Fed is also a regulator, and the fact that along with other banking regulators, we oversee banks, try to help control the risks that they take, and try to help maintain their stability. The other thing which is very important, and I think there'll be a lot of broad interest in this, the Federal Reserve was founded in large part to deal with financial crises, to be available to support the financial system during periods of panic and to try to stabilize the financial system. This function got a lot less attention during most of the post-war period, and most people began to think about the Fed as primarily a monetary policy institution. But obviously, with the crisis that we've had recently and crises in other parts of the world, central banks have become much more engaged in supporting financial system, creating financial stability, and explaining that basic function, I think, is also very important.
Chairman Bernanke, what effect is the euro crisis having on the U.S. economy, and what would a centralized European fiscal policy, what effect would that have on the global economy?
You have about an hour? Well, the European situation is very difficult. I mean, the basic problem there is that, like the states of the United States, they have a single monetary policy. There's one central bank, the European Central Bank, that makes monetary policy for all 17 nations in the Eurozone. But unlike the states of the United States, they don't have one fiscal policy. Each country has its own parliament, its own prime minister, and its own fiscal policy. So it is as if in the United States, during a downturn, individual states know that the federal government is there to pay Social Security, to pay Medicare, to provide defense, all of those broad government functions, and each state and locality only has to deal with its more local services that it provides. In Europe, each country is basically responsible for its own fiscal situation. Now, since there are some countries that are weaker fiscally and they're involved in tightening their belts in a very strong way, the results of that are weaker economies in those countries. And indeed, most of Europe is now suffering a much weaker economy. On top of that, their banking system is been stressed by the fact that banks hold a lot of sovereign government debt, which in turn is hurting the financial positions of the banks and reducing the amount of lending they're willing to do. So the European continent, and particularly the Eurozone, those 17 countries that share the euro, are under a lot of economic and financial stress.